Coming up today, stocks continue to pull back. Is the era of financial magic over? What Bill Gross thinks about gold? The latest numbers from Tesla? Is a macro fog approaching? And is now the time to buy the dip or get the hell out? It's a big day, guys. Let's go. And welcome back, everybody. Looks like the market is continuing to pull back, led by high beta growth and momentum names. We can see that in crypto pulling back and small caps in general, along with other risk-sensitive sectors like biotechs, home builders. With energy the best performing sector today, thanks to new sanctions on Russia ahead of the peace agreement with Ukraine in a couple of weeks. That's why we saw a bit of a bump up in oil today. Precious metals were flat after yesterday's sell-off, and we also saw a bit of weakness in tech-related shares. But just looking at the new meme ETF, down 7% today, on no new big news or developments out there, shows this price action is really about a leverage unwind, has pretty much nothing to do with anything else. Things getting sold are just owned on leverage. And so if you understand that, everything else becomes easier to process. As I do see a bit of fear and panic selling out there, and it's days like today, that reminds me why I never use margin and have good position sizing and risk management in place. Because remember that environment always takes precedent over the individual setup. Doesn't matter how good the setup looks, if the environment is tough, the setup won't work. But we did get a few signs of a buy the dip price action late in the day, just looking at the Russell 2000. And remember, November 10th is about 2.5 weeks away, when the US and China must reach an agreement on trade or a new extension before the 90-day current extension expires. And so Xi and Trump are set to meet in South Korea later next week. And it's possible we could get a trade deal done before then. And then that meeting is used as a celebration photo opportunity that could be of benefit to both. But as the odds currently stand, I do think it's likely we'd get a deal or an extension at least before November 10. And so this very well could prove to be a buy the dip opportunity over the next week or so into the bullish period of late October, early November, which we can see here in the seasonality chart. Looking at the 22nd today, historically speaking, the next week can be a bit soft before the last few trading days of the month. Things can start to pick up, especially the first week in November, some of the most bullish weeks of the year. Same when looking at seasonal fund flows. We can see it come off getting into late October, then before November starts, it can bottom out. And companies and funds can quite often come back into the market at that time. Because even though on the main indices, it doesn't look like we're that oversold, underneath the hood, a lot of the hot names are already deeply oversold, and we can see that in the fear and greed index, which was in the extreme fear zone earlier today before finishing just inside the fear zone. Because again, looking at Polymarket, still overwhelmingly favorable odds that Trump will meet with Xi Jinping in South Korea next week. Same deal with the tariff agreement, 77% chance. So that's a good sign that things are still progressing, and China's kind of in a position where they have to act. Their economic growth has been the weakest this year in a long time, and they no doubt don't want to see that get any softer because their number one mandate is social stability, and to achieve that, they need to keep their economy fully employed and growth still on track. And trading with America is still worth over $500 billion a year to them, employing millions of Chinese. And that's why I think we're likely to get a deal, which could very well put a hard floor in the stock market. But apart from China, what other risks are out there in the market? Well, according to Bank of America, there could be some macro fog and credit cockroaches on the way. They see 5 big risks, the first being there's signs of a bear market flashing. Even as market growth appears robust, those that tripped over the last few months include high PE, expensive versus cheap stock performance, and credit indicators. Second, they say the AI boom is at odds with consumer resilience. The rise of AI may compel companies to eliminate more white-collar workers who have helped drive robust consumer spending. Third, they see risk of the government buying stock. They see it more as a bailout than a strategic investment. Fourth, they still think there's macro fog around tariff impacts, as well as a lack of new data during the government shutdown, and a pause in activity is likely on constrained visibility. And finally, they think there's canaries and cockroaches in the private credit world. As Jamie Dimon said last week, there's never just one cockroach, and there's probably more to come. Referring to Zion's Bank a week ago, which announced a $50 million loss, has already sparked fears of a potential credit crisis. We got another one today from Business Insider. The era of financial magic is over. Retail traders have lost $17 billion betting on shares of Bitcoin treasury companies. Also known as DATs, digital asset treasuries have boomed in 2025. They didn't really say why this strategy's over, only that they think retail traders have already lost around $17 billion on it. And that from here on, success will depend on trading discipline, market timing, and genuine alpha generation. But in my opinion, the retail trading crowd is still well and alive. We've seen that in Beyond Meat this week. After a huge 2-day gain, it's had a bit of a pullback today after a monster gap up, and billions of shares traded this week. I don't think retail traders have left the building just yet. But also adding to that bearish sentiment is Jim Cramer. Came out this morning and said, meme gunners are taking up Beyond Meat today. With gold up, I expect a rearguard action on nukes and quantum, Beware of massive equity and convert deals today. This selling is real. And what about gold after its pullback to start this week, recording some of the biggest one-day drops we've seen in many years? Billionaire investor Bill Gross thinks the top may be in, as he thinks the precious metal's acting more like a meme stock than a safe haven asset, which he may have a point after we've seen photos of people around the world literally queuing up to buy gold at all-time highs. We've also seen a record in the amount of people searching for the term buy gold in Google. In fact, we just saw the highest spike in this term since August 2011 by more than double, and that was August 2011 there, when gold peaked out at 1900 and spent the next 10 years consolidating. Or is this time different and all those millions of people are right? At least in the short term today, we did see a little bit of dip buying in the afternoon. You can quite often see a retrace and retest, as tops can be more broad and take longer to form than bottom. And so it very well could bounce back up to 4,300 an ounce, but whether it takes out 4,400 an ounce is still yet to be seen. Gold mining ETF appeared to buy the dip this morning, right off the open, has pulled back a little bit more than gold. Same with uranium as well. Did get a few signs that the dip was bought here, and we've actually got a few other commodities performing well today. Platinum up over 5%, and crude oil on the fresh Russian sanctions finding support there yesterday. But just moving on to the latest from Tesla and their earnings. Posting record revenue but falling short on profit. So I was wrong that they were going to beat on EPS, but I was right that they were going to beat on revenue. Showing there's still good growth across the company. They've just got higher capex, attributing their decline in profitability to increased research and development costs such as AI, robo-taxis, and Optimist bot, which they should be spending. Typically, companies that have the best R&D budgets can innovate the most and have the best long-term returns. So nothing wrong with that long-term, especially with their revenue beat. Coming in at 28.1 billion, well ahead of Wall Street expectations of 26.5, but just a little bit of a miss there on EPS, and just going down to the 5-minute chart. Stock did sell off a little bit, but not too hard. Already appears to be recovering, not down quite 1%. So the market doesn't seem too upset with this result. It's already been on a good run the last few months. They still reiterated they're on track with robo-taxis. So overall, I think a pleasing result. We also just got a big announcement from Google today, a breakthrough in quantum computing, announcing its new algorithm, Quantum Echo, which ran on its latest quantum processor named Willow. The algorithm solved a molecular structure calculation and achieved what's called a verifiable quantum advantage, meaning the quantum machine completed a task that classical supercomputers simply cannot match, doing so around 13,000 times faster than the fastest conventional computer. And so what makes this meaningful is not just its speed, but that the result is verifiable and meaningful for real-world science. And Google says this opens the door towards practical applications such as drug discovery, materials science, and new types of AI-driven research by using quantum machines to explore molecular structures and phenomena that are out of reach today. So while we're not yet in the era of full-scale, fault-tolerant quantum computers, this milestone signals that the future of useful quantum computing is starting to come into view, with Elon Musk commenting on Sundar Pichai's post today as well, saying congrats, looks like quantum computing is becoming relevant. And as a look at Alphabet, Google shares holding up just a few points below all-time highs. We get to hear earnings from them this time next week. I'm expecting them to come through with another beat as well, as I think they're firing on all cylinders. Waymo's really picking up. We've seen great growth in Gemini the last few months. No doubt YouTube's at all-time highs. Google Search as well, and more companies wanting to use their TPU chips. I think it all looks pretty good for Alphabet Google. So I wouldn't be surprised to see them gap up to new all-time highs next week. And if the market does find its feet over the next couple of days, some of these quantum computing stocks could prove to be a good buy the dip opportunities for a swing trade at least. Looking here at one of the biggest, Rigetti, and it's drawing a fib retracement from its low to its recent high. We're pretty much already in the golden pocket, around that 50-60% retracement, where you can typically find pullbacks and uptrends, find support. Same deal with D-Wave Quantum as well. Could very well find support over the next few days, around 25 a share or so, because this great news from Google kind of just makes the illusion real with what quantum computing will eventually be able to do. So no doubt, still very much in the speculative phase of this sector, but that fundamental development could get the market excited for this sector again soon. Along with small cap healthcare growth stocks that use AI like Tempest AI, I think it's very likely AI will make a major health and biotech discovery and breakthrough at some point over the next year or two. It's really going to accelerate the life sciences, and I think stocks like Tempest could benefit, and a lot more speculative Ginkgo Bioworks, ticker symbol DNA, as they're now able to edit DNA and read it just like a programming language. And other new age healthcare stocks as well could be setting up a buy the dip opportunity, like Hims and Hers Health, pulling back on low volume here. Big support around $45 a share, and they continue to grow, offering a modern way for Americans to access healthcare over the phone and internet. A lot more convenient for everyone. Otherwise, looking throughout my themes watch list, definitely some sharp pullbacks continuing, as was to be expected after a hot run. Did just get a big beat from Intuitive Surgical, one of the oldest robot companies making surgical robots. Came through with a healthy 20% beat, with the stock having a nice gap up today. And these hot nuclear stocks, like many of these stocks, now sitting around their 50-day moving average. Some even going a bit further, like NewScale, SMR, down to multi-month support here. But a lot of them, like Plug Power, are pulling back on low volume, which can be a good sign. If the up days are attracting the big volume, typically the market wants to go where it can find the most volume. But like I said, we are getting into the thicker Q3 earnings season, so expect a bit more volatility over the next week or two, especially as we go into the US and China expiration date of their 90-day extension. The market will be keen off that. And we're also supposed to get a Fed rate cut next week. So along with that bearish seasonality for the next week, we could still stumble around, pull back a little bit further, consolidate. Then we get that really nice end of month bullish seasonality into November. And that, coupled with some positive developments in US and China, could very well give the market meaningful support, as many of these hot names like SoundHound AI did show some late day buying the dip here. But like I said, after the huge run up in some of these names, no surprise to see them pulling back, like Iron and other hot drone stocks like Red Cat, I think could be close to finding support, as again, we're seeing these pullbacks on low volumes. Also, Ethereum treasury companies like Bitmine coming down to big support areas on the cusp of reporting earnings next week. And so we pretty much just have to get through this seasonally weak period, Q3 earnings, and the US-China deal. That's kind of what needs to be cleared away before the market should be able to find its feet again. As pretty much all hot themes, even rare earths, got a lot of names sitting just underneath 50-day volume weighted average. But overall, the market is still technically healthy. 63% of S&P stocks above the long-term 200-day moving average. And we haven't seen a breakdown in market breadth, with the amount of stocks breaking out to new lows is actually quite tame. Along with volatility, a little bit of a spike there this morning before finishing at 18.5, and the term structure still in contango, meaning the market's not too worried about volatility right here and now. And looking at the price action and bond yields, very much expecting another rate cut from the Fed next week, which, looking at Fed Fund futures, is pretty much priced that in as a lock, along with another rate cut in December. And so, like I said, looking at poly markets, pricing for a US-China Trump deal, and the price action in Chinese securities, doesn't appear the market is too worried about that. So that should happen. And I know we're getting this buzzword of there's more than one cockroach in the US banking system, but just looking at credit spreads and the fact that the Fed has backstopped and is willing to do whatever it takes to get out in front of it and backstop it if need be, in my opinion, is not a big pressing issue at this stage. And we're getting some supportive price action in Bitcoin as well, which should also like the prospect of lower rates. And let's not forget, we get a new Fed chair in May next year. So there's a lot to look forward to. So in my opinion, I'm cautiously optimistic. I think over the next few days, week or so, there'll be opportunities to buy the dip, as we should get a US-China trade deal. Q3 earnings should come in good. We get back to that bullish seasonal period. We get another Fed rate cut, along with a good chance of one in December as well. And since sentiment readings are already showing plenty of bearishness and fear, it may just have been a bit of washout of froth that we needed here. Of course, anything can happen. It changes day to day, but that's how I see it as of right now. Thanks very much for sticking with Click Capital, and I'll be back again this time tomorrow. Cheers.